let's get back to the machine, this climate risk now. This is, as I said, 3 chapters are there. Uh, the third one is quite, all about principles and everything, but it is very important. And I would say that GARP really focuses on these things. So if you get 4 or 5 questions within these 3 chapters, I think that's going to be a bonus points. So let's start with the climate related risk drivers and their transmission channels. Okay, so what is the first thing we have is a describe the climate related risk drivers and explain how those drivers give rise to different types of risk for banks. Compare physical and transition risk. Okay, it's very interesting. I would say that, not boring at all. Very interesting. So climate risk is divided into 2 types. The first one we have is a physical risk, and the second one we have is a transition risk. Now we're talking about the first one, trying to understand what is a physical risk. Physical, we have 2 things. One is an acute, and the second one is a chronic. Okay, under the acute, you have the rising global temperatures, like the temperature is rising, causing heat waves, floods, right? More severe rainfall. All these are examples of acute, acute physical risk. The other example is a chronic risk. Here, there is ecosystem is changing. Okay, the ecosystem is changing. There is a desertification. People are not able to live on that particular land, and hence they have to move out. So that's a chronic risk. You just have to leave that. There's nothing that can be done. Population migration. Okay, rising sea levels. Due to this, there's a population migration. People are not able to stay there. That's a chronic risk, a permanent impact. That's what the chronic risk is. Now on the exam, they'll not ask you, okay, what is a chronic and acute risk? But overall, understand physical risk is all about the rainfalls, the heat waves, the flood and everything. And it also has a chronic impact like desertification, ecosystem is changing, the migration of the population. So that's broadly what we have it here. And understand the impact of physical risk varies by region. Okay, geographically, there's going to be more rainfall in a certain area as compared to maybe another region, right? So it totally depends upon region to region, geography versus, region to region is all we can understand. So that's the physical risk that we have. Another risk that we have is known as a transition risk. Now, what is a transition? Transition means that there's a lot of, as you can see this image, there's a lot of pollution, right? And this pollution leaves, it releases a carbon dioxide. And this carbon dioxide, what it does is that it gets accumulated in the clouds, right? And that causes heat waves. So basically the root cause, because of these industries and all the cars, the fuel, basically the fuel, fossil fuel, the use of that has given rise to increase in the carbon dioxide in the atmosphere. So we want to transition from high polluted or this carbon dioxide to a low carbon economy, like, EV, electric vehicles and all those things. That is the transition from this to this. But having said that, that is also a risk. So transition risk relate to society shifting towards a low carbon economy. So high carbon is a very bad thing. Now, global temperatures have risen due to increased greenhouse gas emissions from human activities. And these emissions lead to environment risk, like the sea level is rising, heavy rainfall. So basically the emissions give rise to these physical risk. There can be mudslides, there can be droughts, there can be wildfires. Now, that's what we want to do. We want to transition from a high carbon to a low carbon economy. That's what the focus is. But these transition risks can also give rise to certain risk. Now, curbing emission requires regulatory, technological, behavioral change, right? It requires a lot of things. So what are the transition risk drivers? Now, what drives transition risk? So what are the drivers for moving from a carbon reliant to a low carbon economy? Well, first one is the climate policies. What is the public measures and regulations to reduce the greenhouse and promote that particular thing? Is the policy favorable, unfavorable? That will decide the transition from this to this. What is the technology changes? Are you adopting EV, cleaner, efficient technology, which can lead to added cost or maybe operational expenses? So obviously everyone is trying to transition to a low carbon, but do you have that operational expenditures and everything? So that's another challenge. Investor sentiment. So growing awareness of, I think if you're not able to understand these things, next page you will understand it in a much better way. Okay, so hold on to that particular understanding in a much better detail for transition risk. Investor sentiment, growing awareness. Awareness is growing about the carbon emissions, right, among the investors and their influence on climate conscious investments. Maybe I'll invest more in Tesla because, as an investor, probably I'll do that. Consumer preferences. So the shift is in consumer behavior towards eco-friendly products that can impact businesses. So that's kind of like a transition risk drivers. Now, evaluating these risks is complex. Why? Because it's uncertain. There's a rapidly changing and the non-linear nature of climate risk. Climate risk is not a linear thing. It's a non-linear. It can just go on and on like an exponential. That's what it is. And moreover, there is a geographical diversity. What happens here in India probably may not happen in the US, right? There's a geographical diversity as well. That's what it is. Okay, moving on to the next learning objective, and that is the transmission channels. Understand what is a transmission channels. Transmission channels are the chain or links, basically cause and effect. These are the causal chains. Okay, so transmission channels are the causal chains linking the climate risk to the financial risk. That means the climate risk will give rise to some sort of a financial risk. And there are two types of transmission. The first one is a macro level, like that can affect entire country or probably the broader economy. And the other one is a micro level transmission. That means if there is any climate risk, that can transmit into financial, but on a very small scale, like individual counterparties. Maybe indirectly it affects banks and their financial assets. Maybe I have 10 branches, but one branch of a bank is near a seashore. Now, if anything happens in this rise in temperature, probably this particular location is impacted. But maybe the 9 other branches that I have, that is not near to this seashore. So that's a microeconomic channel. Only one bank is affected, not all. Now, what we're going to be doing is, for this particular chapter, we need to understand, okay, what the learning objective saying is that on a micro level and also on a macro level, how the different risk that the bank faces, market risk, credit risk, liquidity, operational, how it all affects, how the climate risk that affects the overall banking, okay, on a broader level, macro level, on a micro level. First, I'll talk about the micro level or a microeconomic transmission channel. Transmission is nothing but how the climate risk is transmitted to financial risk. So micro level, okay, think about micro, individual counterparties, like mini level, not a very broad level. Okay, first talk about the market risk. Climate risk drivers can have significant impact on the value of financial assets. Specifically, if there is any, physical, what is physical? Acute, chronic, like a flood, hurricane, this, that. Transition is transitioning to a low economy, a low carbon economy. That can change information about future economic conditions or the value of a real financial asset. So basically, the stock prices can go up and down. Market risk is what? Stock prices, right? Financial assets, stocks, bonds, all these things can, the value of it can have a significant impact of a particular stock, particular company. Like let's say electric vehicle companies, their stock will go up. Others maybe go down. So that can result in downward price shock and in the micro level of this particular thing. Both physical transition, both can affect. Climate risk could also lead to breakdown in correlations between assets. So the correlations can be broken. And that reduces the effectiveness of hedging that you do. And that challenges banks' ability to actively manage their risk. Okay, so I've underlined these things. It can have, in terms of market risk, significant impact on value of financial assets. The value of real financial assets can come down. Market volatility goes up. Breakdown in correlations. All that you need to remember for the exam. Okay, when it comes to liquidity risk means what? The liquidity is what? You will not be able to get money. Okay, what about the micro level? Well, it can impact banks' liquidity risk directly because you will not be able to raise funds or maybe sell that property which is near that seashore, which is near that ocean. Let's say that you'll not be able to liquidate that. Directly, you'll not be able to do that. Indirectly, customer demands for liquidity. Customer will just take out their money, run on the bank. So severe natural disasters can trigger sharp increase in precautionary demand for liquidity. If households and corporates are affected by physical risk, like for example, there is a flood. So all the households, all the corporates, they will need liquidity to finance themselves. So that indirectly affects your liquidity risk. And they may withdraw or draw on their credit lines. So that's impact on the liquidity risk on a micro level. Okay, on a specific bank level or on a specific branch level. Okay, what about operational and reputation? Well, physical hazards can directly affect operations. I mean, obviously your branch is gone, the operations are impacted. Physical, it has more impact. If physical hazards disrupt transport, telecommunications, infrastructure, banks' operational ability may be reduced. Corporates as well as bank may also be increased to legal requirement, compliance requirement, all the rest, litigation, liability cost. Who will own this liability? So if you read the underlined, that will make sense, and that's something that you need to revise for the very last moment. Indirect reputational cost, like for example, providing financing to corporates. Maybe another companies may have been affected, so you will have to provide the finance to them that are held responsible for negative climate impact. So that can have that. So that's what we have it here. Again, micro level, we are still talking about micro level, okay, micro transmission channels. And now we are talking about the credit risk. Credit risk has many aspects, and this can be tested on the exam. So for credit risk, you can have a physical risk as well as transition risk. Both have been separated. Okay, what is a physical risk? Flood, hurricanes, everything like that. Major physical, physical damages. So under credit risk, when I talk about micro level, there can be household effect. How? Now understand, what is a credit risk? The loan, people will not be able to do that. So first off, if there is any flood or hurricane, property will be devalued. Property will be vanished. Home loan, you've taken a loan on property, it's gone. You will have lower equity ratios, debt to equity ratios. Non-performing assets, people will say that, okay, house is gone, I'll not pay. So that's the first impact on an individual level. On a corporate level, there's going to be corporate profitability, sales, supply chains. How will they transport? That will be impacted. Agricultural sector, very, very vulnerable to climate risk. And that can increase the credit risk in turn for banks. So two things, households, corporates, they both are impacted. Even the national level, if you talk about it, or a sovereign level, it can reduce the income tax for the government. And maybe the government have to spend more due to these floods and hurricanes. They will have to shell out more. So there's going to be higher borrowing costs, lower access to debt markets, and increased credit risk for banks. So all these three things, they talk about credit aspect. Physical risk, I'm talking about. Now give a thought about the transition risk. Okay, you're moving from a high carbon to a low carbon economy. What can be the risk when it comes to credit risk? Well, think about the government policy. Changes in government policy, you have to go with the EV, let's suppose that. Directly, the profitability and credit quality will be impacted. There's going to be increased taxes on high carbon emissions. Taxes will be high. Your earnings will be less. Funding would be less because no one would be able to borrow. Or why would they give you for funding a non-EV vehicle? I mean, just think about it. Raising funding cost. So any policy for this transition that can affect the corporates indirectly. Even the assets sometimes can be stranded. Okay, there can be a scenario where the assets will be stranded. The manufacturing facility is next to an industrial house, or maybe any company is next to an industrial house. But probably that can be stranded. And that can again give some credit, rise to credit risk. If you use that asset as a collateral. Okay, that can be. Maybe you have a bond that invest in non-EV. So that can be, people will not accept it, right? It's not a good collateral. So government policy is one thing, that is transition risk drivers. The other thing that we have is a technological change. Adopting new technologies can be costly, reducing the profitability. Entities unable to adapt to new technologies can lead to higher potential credit losses. Okay, so technology, you're not able to adapt to it, loss. Consumer and market sentiments. Market sentiments, like people want to have more eco-friendly, but businesses with less eco-friendly, they may have branding and funding challenges. Changing expectations, increased litigation against fossil fuel producers. You're using too much of fossil fuel that is generating high carbon emissions. You can have some litigations. You know, that can all raise credit risk due to higher default risk. So these are the micro level impact. Now, we're going to be focusing on from the micro level to a broader economy level. Okay, the macro transmission channels. Sorry. And the very first thing that we will use is the very first thing that we will actually talk about is the credit risk. So credit risk is impacted by various factors related to both physical and transition. Again, we are talking about the physical and the transition risk for credit risk. See, credit risk has been described a lot in this entire chapter as against the other market risk, operational risk and everything. But on a macro level, broader economy-wide level, not on individual counterparties or corporates, individual, no. On a broader level, how the credit risk can be affected by these climate risk. If I talk about physical risk drivers, climate changes can lower economic output. The overall GDP output can come down. Mortality rates will go up due to high pollution or due to high carbon emissions. Reduced labor, see, mortality rates, not for the transition, but rather here floods, any hurricanes or anything like that can have mortality rates. Reduced labor productivity, supply disruptions, and so on. Natural disasters affect poorer municipalities a lot. higher cost borrowing expenses, and so on. Developing countries are more affected by climate, resulting in higher borrowing cost. And that impact country level credit assessment as well. I think pretty much self-explanatory. Climate risk can trigger socio-economic changes as well. Like there can be conflicts in affecting borrower credit worthiness. So that's on a broader level, on an economy wide level, on a country level that you can think about. How about the transition risk? Now we're talking about the transition risk from high carbon to low carbon emissions. Well, weakened country counterparty credit is the primary impact on banks. Counterparty credit worthiness would be weak. And if you transition away from fossil fuels to a low carbon, can have stranded assets. All your non-EV cars will be stranded, and that can impair your sovereign incomes. For example, 80% of global fossil fuel reserves will become stranded, affecting debt serviceability and credit ratings within that country. So whoever has that, the sovereign will be impacted, whoever is dependent upon fossil fuel. Lower country GDP may negatively impact household, reduce in, again, that's the GDP is low, household income will be low, and again, borrower credit quality will be low. So that's indirect impact. But that's broadly what we have for a micro level when I talk about individual wise, and when I talk about the macro level, both under the physical risk and the transition risk drivers. Now, finally, on the macro level, on a actually it should not be a micro, it should be a macro level. Transmission channels. So if I talk about market risk now, climate change poses market risk, how they can impact sovereigns, and they cannot access debt market because the country GDP will be down, the sovereign will be at risk. So debt market will take a loss. Higher sovereign risk, maybe credit downgrades, and banks within the country may experience credit. So basically all the credit risk only, but broadly speaking, it affects the market risk as well. Maybe your portfolio will go down on an individual level. So that's what we have it here. Okay, now moving on to the next learning objective, and that is describe and assess factors that can amplify as well as mitigate these risks. So what are the risks that can amplify climate risk and that can mitigate these risks? So I'm going to first, I'll come back to these geographical heterogeneity later, but I'll just talk about the things that can amplify and that can that can reduce the risk. So what can amplify climate risk? Interactions and interdependence between climate risk drivers, feedback of financial risk, combined impact. Let's go through these three things individually. Let's look at the amplifiers. The risk drivers are interacting between each other. There is a transition risk that is going on. That means there is a lot of industries, they are generating high carbon emissions, or maybe let's say there has been a EV plant that has been set up, and within near about that EV plant, there is a flood. So this is a transition, this is a physical. They can interact with each other. So when these two risk drivers, physical and transition, if they interact, that can be amplified. The risk can be amplified. So a joint consideration of these two risks happening together may be necessary, and simultaneous introduction of climate mitigation, and that's what it is. So risk driver interaction is all about that. While the future path of each climate physical is itself uncertain, we don't know when there can be flood, when there can be this, so it's quite uncertain. The dynamics and interaction create additional uncertainty. If we have EV plants and anything or anything happens out there flood or anything, that can be additional uncertainty. So basically risk driver interactions is the first amplifier. The second amplifier, and understand this point, Moreover, interactions between physical and is can reinforce each other. One risk can give rise to other one, another this can give rise to another one. So that can be amplifier. The other amplifier we have is a financial amplifiers. Financially, the risk can be amplified. Okay. The materialization of climate risk on the balance sheet can be amplified by behavior of the people. By the behavior, how the people take up this particular event. Do they sell your stock? Do they buy the stock? How it interacts with the overall economy. So that can be a financial amplifiers. Climate change may affect the future availability and affordability of insurance. Understand, you are trying to insure the manufacturing unit, but climate change is happening. The availability of insurance can be affected and affordability, maybe the premiums can go very high. So again, that's a financial impact and it can amplify the climate risk damage. The insurance coverage may be reduced, availability may be reduced. The loss of insurance or its unaffordability can act as a financial amplifier. So you just need to understand this. So all the things that I've underlined, just go through that, you'd be good to go. Risk driver transmitted through multiple channels. A given risk driver may impact a bank through more than one transmission channels. So obviously, as I said, a given risk driver can, there can be flood, there can be loss of insurance. So flood and insurance, both can be impacted. So there can be multiple channels that can be having that. Maybe macroeconomic transmission channels, both can be, they can interact and they can give more losses. So these are the amplifiers. Is there any mitigant? Can I reduce the climate risk? Yes, I can. I can. Definitely I can have these things. I'll look at the bank behavior and the business model. I can create some investment strategies so that I can manage against some aspect of climate risk. I'll use certain amount of investment strategies. I will diversify my portfolio. I will make sure that these diversification, however, they can become less effective as increasing global temperatures lead to more widespread or correlated extreme weather events. So understand, I'm going to create that strategy, I'm going to diversify, but understand they may become less effective, okay, over a period of time. Banks may proactively reduce their climate exposures to shifts in your business model, moving towards low carbon and balance sheet exposures over time. Adjust and calibrate their credit models. Seek to increase their financial resources so that you reduce. So basically, overall, the point is this: your behavior and business, the behavior and business model, that's something that you would actually do it. Okay, just hold on. I'll just, the light. All right, that's one thing. The bank behavior and business model. Availability and pricing of insurance. Well, bank insuring itself, the bank's counterparty insuring itself. I think the light is gone. Just hold on. Okay, now I think the light is proper. All right, so I can have a insurance. That's another mitigant that I can use. I can insure myself, the counterparty insuring itself. Okay, the insurance can reduce the financial impact of natural catastrophes. Risk perception and making insurance compulsory. However, insurance coverage is limited. Maybe I can have some another alternative source of capital like insurance linked securities. I can use that. Catastrophe bonds, I can go ahead and I can purchase that. Okay, I can have a insurance linked security wherein the payouts are based on a trigger event. Okay, but understand, I can have an insurance linked securities as a mitigant, but the payouts would be based on a particular trigger event, like there is a flood, there is a hurricane, like that. But yes, definitely I can use the insurance as a mitigant. The other thing I can use is I can use the depth and maturity of capital market and opportunities for securitization. Basically, I may have assets, I may have given loans to nearby a seashore or a ocean. I have all these home loan borrowers I've given it the loans to. Maybe I can reduce or transfer the risk via securitization. I can just bundle these mortgages. I can transfer it as a securitization. I can reduce my risk. Basically, that's the point. So I can use some securitizations. Lender may transfer risk by originating loans in a climate vulnerable areas, and then I can securitize them. That's one thing that I can do. All right, so that's the securitization. Hedging, I can have a weather derivatives. They may be more limited in their ability to provide protection, but still, I can use a weather derivatives. Recent years have seen innovation in climate related derivatives as well, such as ESG futures, carbon derivatives, and as well as water derivatives. So these are the instruments that I can actually use as part of the mitigants as well. And finally, as I said, just understand the factors that impact the climate related risk. So few factors that affect the climate related risk. Understand that climate risk is based on different geographies. So there is a lot of heterogeneity when it comes to the climate risk. The climate risk exposure can vary by location, by the industry sector, jurisdiction, and even the business nature. But broad geographical factors are market, economic, and financial system. That's what we care about actually. So we're going to be talking about the 3 points, these 3 points we will talk about now. And that will actually talk about how geographical heterogeneity affects the different jurisdiction. Now you think about just the different geographies, different locations. Okay. So what can be the climate risk drivers? See, average temperature is rising globally, but temperatures vary across jurisdiction. Maybe some country it may be more, some country it may be less. So banks in high physical location risk locations, they may face more adverse impact. That's one thing. Okay, because as I said, climate risk, it can impact geographically to different locations. Extreme weather events have impacted banks in Asia, Europe, and Latin America. Transition risk arise from government policies, technological innovation, and attitude changes. So transition risk, that can pretty much happen from the policy of a particular government and so on and so forth. Any technological innovation that has happened. So climate risk drivers, they depend upon different geographies. Economic and market structure of climate risk also depends on different geographies. Now, differences in economic and social policies, insurance, they all have, obviously economically the situations would be different, socially situations would be different. Insurance availability will be different in separate countries. That's how the climate risk will be impacted via different geographies. That's one thing. Emerging market are more exposed to physical as well as transition risk than the advanced market. That's one thing. Short-term resilience come from low GDP to debt ratio. If there is any flood or anything, for a short term, you will not be able to get out of that particular stress. But if you have a long-term resilience, if you want to have a long-term resilience to the climate risk damages, you need a flexible exchange rate, a good infrastructure, stability of the financial sector, and low inequality. If you have these things, you can resilient, you can be actually resilient towards this climate risk damages. That's one thing. Countries that are dependent more on labor and outside activities are more adversely impacted by weather changes. So they are dependent upon labor and outside activities. They're going to be more impacted by weather. So we spoke about economic and market structure of a particular country and how it affects and how the climate risk differs by geographies. Financial systems. The structure of financial markets can also impact a bank's climate risk exposure. Countries with large share of small local banks, they are likely to see increased lending to consumers and businesses following adverse weather events. So if there is any adverse weather event happened, if there are a lot of small local banks, they can give more money to consumers and people to get out of that particular thing. Securitization, how the securitization of assets can be done, that can also impact the climate risk, the effect of climate risk, basically. Developing economies increase exposure and have they are more exposed to climate risk. So again, the same point. So that is what we have for this particular chapter. If you have any questions, you feel free to ask. This is important.